two batches of data will dominate the macroeconomic headlines in the coming week. On this side of the Atlantic, we have the latest Purchasing Managers Indices, or PMIs, for the UK. These surveys of activity levels for the manufacturing, construction and services industries will be released on Monday the 1st, Tuesday the 2nd and Wednesday the 3rd of July respectively. Now remember that a reading above 50 is usually indicative of future growth and expansion. One below 50 can be suggestive of a slowdown or even a recession. And in all honesty, the scores for May weren't that encouraging. So in last month, manufacturing came in at 49.4, its lowest score since July 2016. Construction came in below 50 for the third time in 4 months at 48.6. And the only good news came from services, which improved for the second month in a row to 51, although even that was below its 12-month average of 51.9. This does all suggest that the UK economy slowed in the second quarter from the first, when output grew 0.5% quarter on quarter and 1.8% year on year. But we'll see. Now over in America, all eyes will be on the latest monthly jobs, unemployment and wage growth numbers that are due for release from the Bureau for Labour Statistics on the Friday. Now in May, America added just 75,000 non-farm payrolls in May, well below expectations and below the 12-month average gain of 190,000. Worse, the initial estimates for March and April were revised down. Now that's a trend to watch, as you tend to see those downward revisions when America's economy is slowing down or even going into recession. It's too early to make that call right now, but the US Federal Reserve is concerned about growth, given its apparent newfound bias to cutting interest rates rather than raising them. Perversely, therefore, a weak number could be seen as good news for stocks and bonds, at least in the short term, as it increases the likelihood of a Fed rate cut. A strong number, anywhere near the 190,000 average of the last 12 months, could be seen as bad for stocks and bonds because it may persuade the Fed to hold off on the rate cuts, hopes for which have given share and bond prices a boost of late. Investors do need to be careful what they wish for, however, as the 2000 to 2003 and 2007 to 2009 bear markets and recessions showed weaker non-farm payroll numbers, but even frantic Fed rate cuts did not immediately stave off that recession or stock market collapse. Now this chart shows the absolute level of non-farm payrolls added each month over the past year and the effect of the net revision to the first estimate of 3, and the trend has been one of steady downgrades. Back on the home front, scheduled corporate news flow looks relatively thin on the ground, as those firms who have June or December year ends enter their close period ahead of the release of their interim or full year results in late July, August or even early September. However, there are some potentially informative trading statements, results or annual general meetings to come, and the most notable names may include the following: Domino's Pizza on Monday the 1st of July, St Modwin Properties on Tuesday the 2nd, retailers JD Sports Fashion and Topps Tiles, as well as would-be real estate agent disruptor Purple Bricks on the 3rd, and Primark owner Associated British Foods, house builder Persimmon, and troubled clothing retailer Superdry on Thursday the 4th of July. However, for me, the stock most likely to cause a big fuss in the coming week is supermarket giant Sainsbury. The FTSE 100 member is due to report a first quarter trading update on Wednesday the 3rd of July. As we can see here, it's been a pretty tough 12 months for Sainsbury and its boss Mike Coop. The shares are down by around a third over the past year, and that leaves them trading at not just a one-year low, but their lowest level in at least 30 years. There are 3 possible reasons for this, frankly, if not more. The first is the ongoing onslaught from the discounters, Aldi and Lidl, who continue to take market share in the UK grocery business. Their combined share is now 13.8%, compared to 15.2% for Sainsbury, according to data from industry experts Kantar. Over the past year, Aldi and Lidl have gained 1.1 percentage points of share. Sainsbury's has lost half a point. The second possible reason, well, that's the failure of Sainsbury's planned merger with Asda, after it was blocked by the Competition and Markets Authority, largely on the grounds the new entity would have a leading 30% plus market share. The regulator took the view that Sainsbury's would perhaps look to increase prices and ignored the company's pleas that it would look to cut them. Finally, Sainsbury's full year results back in May did not really please. Even though underlying profits rose, debt fell and the dividend was held after a run of 3 straight cuts, investors focused instead on the weak sales and top line numbers. Retail sales fell in both the third and fourth quarters on a like-for-like year-for-year basis. Moreover, total sales at grocery and clothing also showed signs of stumbling. So, when it comes to the first quarter numbers, when Sainsbury's reveals revenues and not profits, it is these top-line figures that will be centre stage. In terms of the like-for-like retail numbers, sales excluding fuel fell 0.2% across the whole last financial year, when in the fourth quarter alone the rate of decline was 0.9%. Analysts will be looking for improvement here. In terms of total group sales for the whole of last year, well, grocery was up by 0.6%, but the fourth quarter was down by 0.6%. General merchandise was flat after a strong finish with a 0.5 advance in Q4, and clothing was down 0.8 with a drop of 1.6% in the final period. They are your benchmarks for the first quarter figures. In the event that Sainsbury's does talk about earnings, and it doesn't normally, the firm made an underlying pre-tax profit of £635 million last year for a second straight increase, although the statutory number that included all the bad stuff actually showed a third straight drop to £239 million. On an underlying basis, the analyst consensus for this year that's just started, well, that's looking for a 1% drop to £627 million for the year. As a final point, keep an eye on Chief Executive Mike Coop's goal to reduce net debt by at least £600 million this year from last year's £1.6 billion level. Thank you for watching, and I look forward to seeing you next time.